The average American is going to pay somewhere around $500,000 to $600,000 in taxes over their lifetime. That is a massive number. And the crazy part is that wealthy people, people making way more money than the average person, are paying a significantly lower percentage of their income in taxes. And it's not because they're doing anything illegal, it's because they are using a completely different set of rules. Rules that are built into the tax code, rules that are 100% legal. And the thing is, most of these strategies are not locked behind some kind of paywall or some exclusive club. A lot of them are available to you right now, today. You just don't know about them because nobody teaches this stuff in school. So in this video, I'm going to be breaking down 6 legal tax strategies that wealthy people use to keep more of their money. And I'm going to go in order from things that literally anybody can start doing today, all the way up to the more advanced strategies that the ultra-wealthy use to pay almost nothing. And I'll be honest with you, the last 2 on this list are the ones that are going to blow your mind. But before we jump in, drop a comment down below and let me know how much you paid in taxes last year. I'm genuinely curious, because by the end of this video, I think you're going to look at that number very differently. So, starting out with number 1, and this one is something that most people either don't know about or they just don't take seriously enough. I'm talking about the health savings account, also known as the HSA. Now, most people think of the HSA as like a little debit card that you use to pay for doctor visits or to pick up a prescription. And that's technically true. You can use it for that. But that is not what makes the HSA powerful. The reason the HSA is one of the most broken tools in the entire tax code is because it has what's called a triple tax advantage. And that literally means 3 separate tax benefits all stacked on top of each other. So let me break it down. The first benefit is that any money you put into your HSA is tax deductible. So let's say you contribute $4,400 this year, which is the 2026 limit for an individual. That $4,400 gets deducted from your taxable income. So if you made $60,000 this year, the IRS is going to look at it like you only made $55,600. You just lowered your tax bill by contributing to this account. And if you have a family plan, you can contribute up to $8,750, which is even better. The second benefit is that any money inside the HSA grows completely tax-free. And this is the part most people miss. You can actually invest the money in your HSA into index funds, ETFs, mutual funds, just like you would with a brokerage account or a Roth IRA. And whatever growth you see on those investments, you do not pay a single dollar in taxes on it. Not while it's growing, not ever, as long as you use it for qualified medical expenses. And the third benefit is that when you pull the money out to pay for medical expenses, the withdrawal is also tax-free. So you're not taxed when you put the money in, you're not taxed while it grows, and you're not taxed when you take it out. There is literally no other account in the entire tax code that gives you all 3 of those benefits at the same time. Not the Roth IRA, not the 401k, nothing. The HSA is the only one. Now here is where the real strategy comes in. And this is what the wealthy do. Instead of using their HSA to pay for medical stuff right now, they pay for their medical expenses out of pocket with regular cash. And they let the HSA money sit there and compound for decades. Because here is the thing. There is no deadline on reimbursing yourself from your HSA. So let's say you pay $2,000 out of pocket for a medical bill today. You save that receipt. You let your HSA grow for 20 years. And then 20 years from now, you can reimburse yourself that $2,000 completely tax-free. Meanwhile, that money has been growing in the stock market the entire time. And once you hit age 65, you can actually use the HSA money for anything, not just medical expenses. You will pay regular income tax on non-medical withdrawals after 65, but there's no penalty. So at that point, it basically becomes another retirement account on top of your 401k and your Roth IRA. And the best part is, if you do use it for medical expenses, which, let's be honest, everyone has medical expenses when they're older, it comes out completely tax-free. So that is why the HSA is an absolute cheat code, and why I put it as number 1 on this list. If you have access to a high-deductible health plan through your job or on your own, open an HSA today. Max it out. Invest the money and do not touch it. All right, number 2. And this one is for anybody that invests in a regular taxable brokerage account. I'm talking about tax loss harvesting. Now, this one sounds complicated, but it is actually really simple once you understand it. So here's the basic idea. Let's say you bought $10,000 worth of an S&P 500 ETF earlier this year. And let's say the market dipped, and now that investment is only worth $8,000. You are currently sitting on a $2,000 loss, right? Now, most people would just hold and wait for it to come back up, and that's not a bad move. But the tax loss harvesting strategy says, hey, why don't you sell that investment, lock in the $2,000 loss on paper, and then immediately buy a similar but not identical investment. So, instead of buying back the exact same S&P 500 ETF, you buy a total stock market ETF, or you buy a different S&P 500 fund from another company. Your money is basically still invested in the same type of thing. Your portfolio hasn't really changed, but now you have a $2,000 tax loss that you can use. And here is why that matters. That $2,000 loss can directly offset $2,000 in capital gains somewhere else in your portfolio. So if you sold another stock for a $2,000 profit, you would normally owe taxes on that gain. But because you harvested that $2,000 loss, they cancel each other out and you owe nothing. Zero. And it gets even better. If you don't have any capital gains to offset, or if your losses are bigger than your gains, the IRS lets you deduct up to $3,000 per year of those losses against your regular income. So that means even if you didn't sell anything for a profit, you can still lower your tax bill by $3,000 just by being smart about when you sell your losers. And if you have more than $3,000 in losses, you can carry the rest forward into next year and the year after that. There is no limit on how long you can carry those losses forward. Now, one very important rule you need to know about is the wash sale rule. The IRS says that if you sell a security at a loss and then buy back the same or substantially identical security within 30 days before or after the sale, they will disallow the loss. So you cannot sell your shares of an S&P 500 ETF, claim the loss, and then buy back the exact same ETF the next day. That would be a wash sale, and you would lose the tax benefit. But like I said, you can buy a different fund that tracks a different but similar index. So instead of the S&P 500, you buy a total market fund. Instead of a Vanguard fund, you buy a Schwab fund. As long as it's not substantially identical, you're good. And this is a strategy that you can use every single year. Anytime the market dips, you have an opportunity to harvest losses and lower your tax bill. The wealthy do this constantly. They have advisors and software that look for tax loss harvesting opportunities all year round. But you can do it too. You just have to be paying attention. All right, now we are getting into the more advanced stuff. Number 3 is the backdoor Roth IRA. And this one is specifically for people who make too much money to contribute to a Roth IRA directly. So here is the deal. A Roth IRA is one of the best retirement accounts out there because your money grows tax-free and you never pay taxes when you withdraw it in retirement. It's incredible. But the IRS has income limits on who can contribute to a Roth IRA. For 2026, if you're single and your income is over $168,000, or if you're married filing jointly and your income is over $252,000, you cannot put money directly into a Roth IRA. You're locked out. And that sounds like the end of the story, right? Wrong. Here is the loophole. There are no income limits on contributing to a traditional IRA, and there are no income limits on converting a traditional IRA into a Roth IRA. So what you do is you open a traditional IRA, you contribute up to $7,500 for 2026. You do not take a tax deduction on it because your income is too high for that anyway. And then you immediately convert that traditional IRA into a Roth IRA. Because you already paid taxes on the money when you earned it, and you didn't take a deduction, the conversion is basically tax-free. Your money is now sitting in a Roth IRA where it will grow tax-free forever, and you can do this every single year. The IRS has never formally challenged this strategy. Congress actually tried to close this loophole a few years ago, and they failed. It's still here, it's still legal, and millions of high-income earners use it every single year. Now, one thing you do need to watch out for is the pro rata rule. If you have any other pre-tax money sitting in traditional IRAs, SEPIRAs, or simple IRAs, The IRS is going to look at all of those accounts combined when calculating how much of your conversion is taxable. So, ideally, you want to roll any pre-tax IRA money into your employer's 401k before you do the backdoor Roth. That way, when you convert, the only money in your traditional IRA is the after-tax contribution you just made, and the conversion is clean and tax-free. It's a couple of extra steps, but it is absolutely worth it for the tax-free growth you get for the rest of your life. All right, number 4. And this is where the game really starts to change. Everything I've told you so far can be done by anyone with a regular job and a paycheck. But this next one is where the wealthy start playing a completely different game. I'm talking about business expense deductions. So here's the thing. When you are a W-2 employee, meaning you work for a company and you get a paycheck, your options for deductions are very limited. You get the standard deduction, and that's pretty much it. But the moment you have any kind of business income, even a side business, a whole new category of deductions opens up for you. And I'm not talking about anything crazy. You don't need to quit your job. You don't need to start some massive company. Even a small side hustle that you run as a sole proprietorship or an LLC can unlock these deductions. So, what can you deduct? If you work from home even a part of the time for your business, you can deduct a portion of your rent or mortgage, your utilities, your internet, all as a home office deduction. If you buy a laptop, a camera, a microphone, software, any tool that you use for your business, that's deductible. If you drive to meet a client or go to a business event, you can deduct the mileage on your car. If you take someone out to eat and discuss business, a portion of that meal can be deductible. If you travel for business purposes, your flights, hotel, and meals can be deductible. And here's the part that really matters. The IRS also allows business owners to take something called the Qualified Business Income Deduction, also known as the QBI deduction. This was created under the Tax Cuts and Jobs Act, and it basically lets you deduct 20% of your qualified business income right off the top. So let's say your side business made $50,000 this year. You could potentially deduct $10,000 just from the QBI deduction alone before you even start counting all your other business expenses. That is massive. And this is why you hear stories about wealthy people paying lower tax rates than their employees. It's not because they're cheating, it's because they've structured their income to flow through a business, which gives them access to deductions that regular employees simply do not have. And yes, there are income limits and phase-outs on the QBI deduction, depending on what type of business you have. But for most people, especially those just starting out or running a service-based side business, this deduction is available and it is powerful. Number 5, and this is the one that is going to shock a lot of people. I'm talking about the mega backdoor Roth. So, we already talked about the regular backdoor Roth, IRA, right? That lets you get $7,500 per year into a Roth account. That's nice. But the mega backdoor Roth lets you potentially move tens of thousands of dollars into a Roth account every single year. And the numbers are not even close. Here is how it works. Your 401k has 2 different contribution limits. The first limit is the one most people know about, which is the employee deferral limit. For 2026, that's $24,500. That's the maximum you can contribute from your paycheck. But there is a second limit that almost nobody talks about. It's called the total contribution limit, which includes your deferrals, your employer's match, and any after-tax contributions you make. For 2026, that total limit is $72,000. If you're 50 or older, it goes up to $80,000. So let's say you contribute $24,500 from your paycheck and your employer matches $10,000. That's $34,500 total. You still have $37,500 of space left before you hit the $72,000 cap. That $37,500 is your mega backdoor Roth opportunity. If your employer's 401k plan allows after-tax contributions and in-plan Roth conversions, you can contribute that extra $37,500 as after-tax money and then immediately convert it to Roth. And just like that, you now have $37,500 more dollars sitting in a Roth account, growing tax-free forever. Compare that to the regular Roth IRA limit of $7,500. We're talking about 5 times more money going into a tax-free account. That is a game changer. Now, the catch is that not every employer's 401k plan allows this. You need to check with your HR department or your plan administrator to see if your plan allows after-tax contributions and either in-plan Roth conversions or in-service withdrawals. If it does, you should be taking advantage of this immediately. And if it doesn't, honestly, it might be worth bringing it up to your employer because this is a huge benefit that a lot of companies don't even realize they can offer. But for the people who do have access to it, the Mega Backdoor Roth is one of the most powerful wealth-building tools in the entire tax code. You are essentially getting an extra $37,000 or more per year into a tax-free growth account on top of everything else. All right, number 6, the final strategy. And this is the one that the ultra-wealthy use to build generational wealth. I'm talking about real estate depreciation. Now, when you buy a rental property, the IRS lets you deduct the cost of the building over 27.5 years. This is called depreciation. And the idea behind it is that the building is supposedly losing value over time due to wear and tear. But here is the thing. In reality, most properties are going up in value, not down. So you're taking a tax deduction on a loss that isn't actually happening. You're deducting the value of something that is appreciating. And that is why a lot of people call this one of the biggest loopholes in the tax code. Let me give you a specific example. Let's say you buy a rental property for $300,000. The land is worth $50,000, so the building itself is worth $250,000. The IRS lets you depreciate the $250,000 over 27.5 years. That works out to about $9,090 per year that you can deduct from your taxable rental income. And you didn't actually spend that $9,090. It's a paper loss. Your property might have actually gone up in value by $20,000 that year, but on paper, you're showing a loss of $9,090 that reduces your taxes. Now, it gets even crazier. With something called a cost segregation study, you can actually accelerate the depreciation on certain parts of the property. Things like appliances, flooring, landscaping, fencing, parking areas. These all have shorter depreciation schedules of 5, 7, or 15 years instead of 27.5 years. And with 100% bonus depreciation, which was made permanent in 2026, you can write off the full cost of those shorter-lived components in year 1. So you could potentially take tens of thousands of dollars in deductions in the first year alone, just from buying a rental property and doing a cost segregation study. And this is exactly what wealthy real estate investors do. They buy properties, they take massive depreciation deductions to offset their rental income and sometimes even their other income. And then when they're ready to sell, they use something called a 1031 exchange to roll those proceeds into another property and defer the capital gains taxes. They can literally do this their entire life, keep deferring taxes, keep building wealth, and then when they pass the property on to their heirs, the heirs get what's called a step-up in basis, which means all of those deferred gains get essentially wiped out. The heirs can then sell the property and owe little to no capital gains tax. That is how generational wealth is built. Now, I do want to be transparent about one thing. When you eventually sell a rental property, the IRS is going to recapture the depreciation you took and tax it at a rate of 25%. So, depreciation is technically a deferral, not a permanent elimination of taxes. But the power of it is that you get the tax savings now, you invest those savings, and by the time you eventually pay the recapture tax, your money has been compounding for years or even decades. And if you use a 1031 exchange, you can keep deferring that tax indefinitely. The wealthy understand that a dollar saved in taxes today is worth way more than a dollar paid in taxes 20 years from now. And real estate depreciation is one of the biggest tools they use to make that happen. So let me put all of this together for you. Let's say you're someone in their 20s or 30s making a decent income. If you max out your HSA at $4,400 a year and invest it, that's going to reduce your taxable income and grow tax-free for decades. If you practice tax loss harvesting in your brokerage account, you're going to save hundreds or even thousands of dollars per year in taxes that you can reinvest. If you use the backdoor Roth IRA, You're getting $7,500 per year into a tax-free growth account, regardless of how much you earn. If you start any kind of side business, even a small one, you're unlocking the